Stock futures are pointing to a solid open on this first trading day of the year, and it comes after 2024 saw the S&P 500 rise 23%. The Dow Jones Industrial Average was higher by almost 13%. The S&P 500's double-digit gain in 2024 added to a 24% rally in 2023, and the two-year gain of 53% was its best since the late 1990s, when that index rose 66% from 1997 to 1998. Well, with that, I do want to turn to expectations for the year ahead. And joining me now with more is Christine Short, head of research at Wall Street Horizon. Christine, it's great to have you, and Happy New Year.
Happy New Year. Awesome to be here to kick off 2025.
Absolutely. And investors seem to be in an optimistic mood. What is behind that?
I know, it's nice. We're starting off pretty bullish, right? Well, as you said, we've come off an amazing 2024 on top of what we saw in 2023. Expectations for U.S. equities in 2025 is a little more modest. If you look at what some of the banks are expecting, Goldman Sachs, JP Morgan are looking for about a 10% increase in the S&P 500. Certainly nothing to sneeze at. When you do look at the last 2 years, yeah, it certainly is more modest. But they've actually increased that expectation as we went through 2024. So that's always bullish to see. You're going to see some of that trickle into earnings. The U.S. economy is still on a tear. So there's a lot of positive things to focus on for the new year.
Let's talk about earnings, because we do know historically that is the fundamental that drives the stock market.
Yes.
In terms of earnings growth, how are companies looking to fare?
Yeah, so for Q4, we kick off on January 15th. In a couple weeks, Wednesday the 15th, we see JP Morgan, Citibank, Citigroup, and Wells Fargo. So kick off with the big banks as usual. The Q4 season is always a little more elongated just because of the holidays. In any case, they're looking to have a very strong quarter, 12% growth. Overall, the calendar year is expected to post 9.5% growth. So a little lighter than the expectation at the beginning of the year, which is at 11.5%. But still, what a great year. We're almost at double digits. And as we get into the quarter, we usually see more companies beat anyhow. So we could see that number fluctuate a little bit. 2025 expectations are for 15% growth.
That's pretty strong.
Pretty strong. And usually, coming into the year, again, like it's always a little too optimistic. But to see 2024 only ending of a couple percentage points below what the initial expectation was, gives you hope that, maybe we could. And, the more interesting thing, not just, for stocks as well as earnings, is it's going to be a little more broad-based growth that we see. Big banks have said that. Expect to see not just a focus on the Magnificent Seven, which has been the concern the last 2 years, all this concentration in a handful of stocks. What does that mean for markets? Well, it was okay, right? It turned out okay. However, we see a return to healthcare, materials, industrials, some of those beaten down sectors that didn't have a chance to shine in the last couple of years. Expectations are they start to have a comeback as well.
And in terms of inflation, we know that is really dictating the path forward for interest rates. Of course, those set the pace of the cost of money that companies can borrow at to grow, to do deals, to do things of that nature. What is the economy telling us about how inflation could impact this?
Yeah, it's interesting because that's one of the more cautionary notes heading into 2025. And it is because the economy's been so strong that we've seen expectations for rates pull back a bit. So before the September 18th FOMC meeting, where we saw the first rate cut in 4 years, the expectation was we were going to see 6 rate cuts in 2025 from the January to the September meeting. It was going to amount to about 3 basis points of cuts. Now, if you look at the CME Group's FedWatch tool, they're only pricing in about 50 basis points of cuts, so maybe cuts at 2 meetings. That's been pulled back because, like you said, inflation's been very sticky. The labor market's been strong. So the things that are sort of good about the economy mean that we're not going to see those rate cuts. And that makes borrowing more expensive, right? Borrowing stays expensive. We just saw mortgage demand drop 22% in the last 2 weeks of December. So folks aren't going to be as willing to borrow money. We've seen M&A and IPOs really suppressed at the investment banks. There was hope that would loosen up a little bit in 2025. But when you look at some of the Fed rate expectations, it seems less likely. And M&A announcements and closes were the weakest they've been in 2024, going back 5 years. So
wow. It is a factor, obviously, at play here. I'm not sure how closely, Christine, you watch cryptocurrency, but for companies perhaps looking to add crypto to their balance sheet, is that something that you've heard about as we are now in 2025?
Yeah, crypto's been on a tear. I don't follow it closely, but I think my husband owns a little bit less than one Bitcoin, so we've been following. I've been telling him to sell for years, and now he there's expectations, and you read reports. Oh, it's going up to 200,000 in 2025. I don't know what to make of it, but you're right. I have seen companies taking it more seriously as it has been on a tear in the back half of the year. There's certainly some policies that are being laid out under the new presidency that would support and reduce some regulatory constraints around crypto, which makes it sort of enticing. So we'll be looking at earnings calls. Certainly there might be, depending on the company, questions from analysts about what their take is on cryptocurrency, but certainly something I've been watching almost on a daily basis.
Because you do follow those analyst calls so closely, we've been watching some of the data come in. The stock market reacted, obviously, when we had that decisive election result. The fact that there was a result gave certainty to the market. We saw small business optimism rise in the wake of that. Are you gauging that companies do have a better sense of how to navigate this year, and is that factored into these forecasts?
Yeah, so during the Q3 season, a bunch of companies reported before the election, and then, many reported after. So we started to get a trickle of kind of commentary about, okay, we have some certainty around who the next president is going to be. What does that mean for policy? Now, going into these reports, the inauguration is on January 20th. Companies can speak more decisively about plans. We heard a lot about plans last quarter of what would happen if tariffs were imposed. Some companies were going to move production. Some companies were going to raise prices. But at that time, it wasn't solid, right? So going into this next earnings season, we'll hear probably more decisive plans. They'll be planning with more of a compass going into 2025. Analysts are going to ask those hard-hitting questions. So we'll certainly have a better idea of where things shake out.
Christine Short, Head of Research at Wall Street Horizon. Christine, thank you so much for joining.
Thank you again.